be talking about ROIC, returns on invested capital, and growth, which are the two variables that determine whether a company is creating or destroying value. So, how does a company create value? The purpose of a publicly traded company is to maximize value for its stockholders, which is done by increasing the present value of its future cash flows so that it has more cash to return to its shareholders eventually, either through dividends or share buybacks. And two ingredients for increasing the present value future cash flows are growth, which is pretty intuitive, and high returns on invested capital. And they must go in conjunction with each other to create value. So first, let's break down ROIC. So ROIC, just the definition of it, is NOPAT over invested capital. So it's basically, if I invest a certain amount of capital, what will my net operating profit after taxes be? And you can kind of break it up into these two ratios as seen here. Revenue over invested capital, which is called capital turnover. And that's basically, if I invest a certain amount of capital, what will my revenue be? Times NOPAT divided by revenue, which is basically, after I've gotten that revenue, what is my margin on it? So if I have more costs, then it would be a lower margin. If I have not many costs, then it would be a higher margin. So at its core, ROIC is a function of the efficiency that a company increases revenue when deploying capital turnover, and the margin on those incremental sales. So a good way to look at this is by looking at Walmart and Facebook, for example. Both of these are companies that have done very well in the past. They've created a lot of value for their shareholders, but they've gone about it a little bit differently. Walmart is a retail company, and retail companies don't require that much upfront capital. I could go out tomorrow and start a lemonade stand in my neighborhood. I would just need some capital to buy the lemonade and to buy the stand, and I could start getting revenue tomorrow. Whereas a software company like Facebook requires a ton of capital before they can even get $1 of revenue, because they have to make this entire platform and then get people on the platform before they can even begin to monetize it. So these are inherently different business models. Walmart lends itself more to the first ratio. They have a better capital turnover. They can get more revenue when investing the same amount of capital as Facebook. But Facebook has much better margins, because Walmart, every time they're getting revenue, they're having to sell a good that costs them money, right? There's costs associated with it, pretty high costs. They don't have very good margins, right? Very thin margins, but because they're selling so many things, they're making a lot of money. Whereas Facebook has very good margins. After Facebook deploys all this capital to create this platform and then get people on it and then just, upkeep on it, their margins are pretty good, right? It doesn't cost them that much incrementally when they add an advertisement to their platform, which is giving them money. So Walmart is more strong in the first ratio, whereas Facebook is more strong in the second ratio. But both of these companies have had very good returns on invested capital, and as a result have created a lot of value for their shareholders. But this is kind of just how you should think about returns on invested capital, this sentence right here. So now let's talk about growth, which is a bit more intuitive, right? You always hear like, oh, this company has really good growth plans. Growth is kind of a flashy way to say that a company is supposed to do well. And growing revenue can happen in a lot of ways, whether it be organically or inorganically through an acquisition. And the most common ways to grow organically are to expand in existing markets, industries, or operations they've already been doing. So either taking away market share from competitors, or the market expanding and then capturing that growth from the expanding market. Or the other way is by expanding into new markets where the company previously wasn't operating in. And then the most common ways to grow inorganically are through add-on acquisitions, just adding new units to your core operations, or large acquisitions where you're trying to expand into a new industry. So these are the main ways that a company can grow its revenue. But there is a relationship between growth and ROIC that determines whether a company is creating or destroying value. Contrary to popular opinion, growth is not always good for shareholders. Growth is only good when the incremental investment to achieve this growth earns a higher return on invested capital, ROIC, than the company's cost of capital, WACC, right? For example, let's say I want to grow my company's revenue. So you give me a loan at 50% interest with 50% interest rate. And as a result of getting this capital, I can grow my revenue by 1%. This obviously isn't a very good deal for me, right? While I am growing, which you would think is good, I'm having to pay such a high, interest rate, this cost of capital, that it's really not worth it for me to pursue this growth. That's why it's so important to, understand this dynamic of ROIC and WACC. So you kind of just think about it like when you just look at the calculation for free cash flow, NOPAT plus D&A minus CapEx minus change in net working capital equals free cash flow. All these line items after free cash flow are kind of showing your incremental investment, right? So you're investing incrementally to then increase your NOPAT the next year, presumably. If a company was not investing incrementally at all, then NOPAT would equal the same thing as free cash flow. The company would still have CapEx. They'd have what's called maintenance CapEx, which is CapEx, the CapEx required to just, sustain your levels of revenue. They would not have growth CapEx. CapEx can be split into two buckets: maintenance CapEx to keep the same revenues, and then growth CapEx to grow those revenues. So your maintenance CapEx would, probably be around what your D&A is. That's usually what maintenance CapEx is around. So it'd be NOPAT plus your D&A minus your CapEx, your maintenance CapEx, which should be the same as your D&A or around that. So your NOPAT and free cash flow will be about the same because there's not really any incremental investments. But when there are incremental investments, you are decreasing your free cash flow now in exchange for hopefully, increasing your NOPAT in the future. But it's a matter of how much this capital is costing you, your WACC, to deploy it, and what that eventual return will be. So let's look at an example here. So you want to look at ROIC incrementally. If the incremental investments made increase NOPAT enough where incremental ROIC is above WACC, then those incremental investments increase the present value of future free cash flows, right? Going back to that 50% interest rate loan with a 1% increase in revenue, this would probably not, or let's say a 1% increase in NOPAT, this would probably not be creating value. But if you could get a loan out at a 1% interest rate and it increase your NOPAT 50%, then this would be creating value. So you want to look at this incrementally. Let's say my company has NOPAT of $10 and the WACC is 10%. If I were to never pursue any further growth ever, and only deployed capital toward maintenance CapEx to sustain current revenues, then NOPAT would equal free cash flow, right? As you can see here, your CapEx would just equal your D&A because all your CapEx is maintenance CapEx. So your NOPAT would equal your free cash flow. And as we know, we can find, enterprise value by just taking a perpetuity of current free cash flow. And free cash flow, $10, whatever your NOPAT is, divided by 10%, your WACC, enterprise value now is just equal to $100. This is what our enterprise value would be, assuming no growth in the future, right? It's just the value of whatever our free cash flows are now into perpetuity, assuming we never grow again. But let's assume that I have the opportunity at the end of the year to invest $10 into growth CapEx to increase NOPAT incrementally by $2. So you can see my incremental ROIC is 20%, right? I'm investing $10 in new capital to get a 2% incremental increase. So this is a 20% return. And my WACC is only 10%. So since my incremental ROIC is above my WACC, this should be value creative. So I'll show you how this works. Let's say, my NOPAT this year is $10, as stated. And because of this incremental investment, if you just go to the formula back here, my CapEx is going to be $10 more. So it's going to be NOPAT of 10 minus increased CapEx of 10. So my free cash flow will be $0 now. But because of this, NOPAT is increasing by $2. So it will be $12 the next year. And if we assume that we'll, maintain our current levels of NOPAT, we invest just the right amount of maintenance CapEx to sustain this, then as a result of this incremental increase, the perpetuity of that would be worth $120. So EV effectively goes from $100 to, which would just be the $10 in NOPAT divided by the 10% WACC, as I showed on the last slide, to $109, which is just the present value of this perpetuity. It's just this we did have $10, $10, $10, but now we have $0 in year one and then 12 to go on. So we have that $12 perpetuity in year two, and then discount it back to present value. So 120 divided by 1.1, 120 just divided by 1.1 would get us to $109, which is the present value of this perpetuity, because I misspelled perpetuity, or no, I didn't, because this perpetuity is a year from now. So we have to discount it back. So it's not 120, it's actually $109 as a result of this decision to deploy this incremental capital. So this would be a value creative investment, right? our enterprise value went up in the present value as a result of this decision to invest this capital. But if, for instance, our incremental ROIC was 5%, then this would be value destructive, right? Because our NOPAT would not be increasing enough for this to be worth it, because capital costs us money to deploy. There's always an opportunity cost to these sort of things. So if you're investing capital and your ROIC is below your WACC, then the present value of your future cash flows is going down, right? If our WACC was 50% and we were investing $1, then we're investing capital to get a 1% return. That's clearly value destructive for us. And typically, if incremental ROIC is around the same as WACC, then this really wouldn't be value destructive or value creative. It's just kind of keep things the same. So now let's talk about the life cycle of companies. Being able to consistently achieve an incremental ROIC above WACC comes from a consistent competitive advantage, right? This is what someone like Warren Buffett might call a moat, right? This consistent competitive advantage, which allows you to earn returns on invested capital above your WACC for a long period of time. And this can come from, having pricing power, having a really good brand, maybe being innovative. All of these things can cause you to, the things behind invested capital, right? Investing capital and, increasing your revenue efficiently, and then having a good margin on that incremental revenue. All of these competitive advantages can lead to a good return on invested capital. However, competitive advantages do not last forever. For instance, maybe you have a patent, but it only lasts for 20 years. Eventually a company will no longer be able to earn an incremental return on invested capital above weighted average cost of capital. And this is kind of what you call competitive advantage period. Companies are not able to create value forever, right? So you can see with this graph on the right, there's usually a period of time where a company is able to, have this competitive advantage, but eventually too many competitive forces are occurring. Too many people are coming into your industry to try to disrupt it, or, you're having to lower your prices to match, other companies, and the competitive forces drive returns to WACC. So, this is kind of academic theory, but eventually ROIC should converge with WACC to the point where you're really not creating value anymore. There's only a certain amount of a competitive advantage period, but this might not be true in practice. We've seen companies like Coca-Cola have competitive advantage periods for 30 years. So this is more theoretical, but it's important to know whether your company is creating value or not when you're, pursuing these incremental investments. If you were to, right now, the area under the curve is, all positive. But if you started making incremental investments in, ROIC below WACC activities, then, the area under the curve would start to get negative and destroy value, right? So what should a company do when this happens, when incremental ROIC is below WACC? If a company cannot identify any opportunities to reinvest where incremental ROIC is below WACC, then the company should not try to grow and instead return that cash to shareholders through a dividend or share buyback, which I talked about a lot in my last video, right? Returning cash to shareholders and how to most efficiently do that was the topic of my last video. And the company could also potentially look at selling parts of their business operations or spinning them off if they can sell them off at a premium, right? A lot of times in industries where there's a lot of hyped up growth, right? You want to grow. This might not always be the thing to do, right? There's always pressure on management to grow because one, it makes them look good at their job, but also they might have bonuses tied to it. They get clout for having a big company, but it's not always value creative to grow. So a CEO needs to be really self-aware of their reinvestment opportunities. And maybe if this industry they're operating in is super hyped up, they could potentially sell off parts of their business and actually shrink, but do so in a very value creative way by selling them off at a huge premium. Maybe I'm in a business, an industry that's really hyped up and I can sell half of my, organization at a very huge premium. So I'll just get a huge inflow of cash. And then maybe I could, use that to return it to shareholders or do other things for my operations. But it's just very important to, understand this relationship between incremental returns on invested capital and WACC, because this is really determining whether a company is creating or destroying value. If a company has a WACC or ROIC above WACC, then it's really good for them to grow. They're just increasing the amount of value they're creating. But if a company has an ROIC below WACC, then they're really just destroying value faster than they would have. So it's really important to understand this relationship to be able to maximize value for your shareholders. Hope you all enjoyed this video. Thank you for watching.